All right, we might get underway. So welcome all to Macquarie University, Macquarie Business School. Can I start by acknowledging that we meet today on the land of the Gadigal people of the Eora Nation and to pay my respects to elders past and present. Well, welcome to the Macquarie Business School Leadership Series and warm-up event for tonight's State of Origin. I know that we'll want to get done by 8 o'clock so you can all see the Blues beat the Maroons. But this is part of a quarterly series that we run at Macquarie Business School, which is for our MBA alums, for our Masters of Applied Finance alums, and for current students, so that we can begin as a group to talk about what are the really important topics facing our business community. And so that's the great privilege of the kind of conversation we want to lead at Macquarie Business School. And I'm very happy that tonight we're going to be talking about where the next financial crisis is going to emerge. To lead us in that discussion, I'm going to introduce John Romalis. John Romalis is the Head of Department of Economics at Macquarie Business School and completed his PhD in economics at MIT. He's one of the world's leading economists in the field of international economics and trade economics, has held appointments at the University of Chicago, the University of Sydney, visiting positions at Princeton, Dartmouth, and the International Monetary Fund. I'm very delighted that John has joined us in the conversation today and is part of the executive group at Macquarie Business School. And so I'm going to invite John up to the stage to introduce us to tonight's topic and the panellists. So welcome, John.
Okay, thank you very much, Eric. It's been, so welcome everyone here. So it's been nearly 16 years since the Lehman Brothers collapse helped trigger the last global financial crisis, a crisis that kind of ushered in a dismal decade of economic growth for most advanced countries. Financial crises, we know, have a habit of recurring, but the lessons from past crises tend to recede from collective memories. And in some cases, the lessons from past crises even recede from regulations. New threats have a habit of emerging, but they also can go underappreciated. And such new threats could include things such as developments in cybersecurity, artificial intelligence, geopolitical tensions, or even developments in public finances. And that is why we think it is time to explore potential threats to financial stability. And we've been very, very fortunate to being able to assemble a panel of highly esteemed experts. So I'd like to introduce our panel. So firstly, I'd like to introduce Wayne Byres. So Wayne Byres is a former chair of the Australian Prudential Regulatory Authority, or APRA. During that time, he was a member of the Australian Council of Financial Regulators and served as APRA's representative on the Reserve Bank of Australia's Payment Systems Board. Wayne has worked in an advisory capacity at the IMF. He is also currently a non-executive director of Macquarie Bank Limited and ASX Limited. He's also an MQBS alumnus of the Master of Applied Finance degree. So I'd like to welcome Wayne to our panel. I'd next like to introduce Professor Elizabeth Sheedy. Elizabeth is a risk governance expert based in the Department of Applied Finance at Macquarie Business School. She publishes in top international journals on risk governance, culture, and remuneration in financial institutions. She teaches within our prestigious Master of Applied Finance program and the Global MBA program. So welcome to Professor Elizabeth Sheedy. And also we have John Simon. John is the head of the Economic Research Department at the Reserve Bank of Australia. In addition to working at the Reserve Bank of Australia, John also spent 3 years at the International Monetary Fund, where he was the lead author of several influential chapters in its flagship publication, The World Economic Outlook. He has a PhD in economics from MIT. We actually overlapped there for three of those 4 years. And he's published a diverse body of research in economics and policy, which is very highly cited by other economists. So welcome to John. So before we actually get started with the panel, there's just a quick note today is that we're going to have a audience Q&A session after the original panel questions. And so we're using a program called Mentimeter to collect audience questions. So the way to use Mentimeter is simply scan the QR code that's in front of you and is actually on most of your chairs. Or if for some reason that scan doesn't work, go to the website shown on the current slide and submit questions as we go. So there's no need to wait for that Q&A session. You can actually submit questions right away. Also, the audience gets to vote on questions, so you can actually vote to, you can view the questions that have been asked and you can upvote other questions. So essentially the top voted questions will be posed to our panellists, so pay close attention to the questions there. Okay, so is that all, that's all clear? Okay, so now we're going to go to our panellists. And I think I'm going to pose the first question to Wayne. So Wayne, taking current regulatory frameworks as given, what do you see as the biggest risks to global financial stability in the medium term?
That's an easy question to start with, so thank you. And thank you to Macquarie for the opportunity to be part of this evening's event. I really appreciate the invitation. It's difficult to answer that question, I think, because obviously periods of financial crisis and instability in the financial system tend to come from things that markets didn't see coming or markets have trouble pricing for. And perhaps unlike the global financial crisis and some crises that we've had in relatively recent times, if I had to bet, I actually don't think the next crisis comes from the traditional risks in the financial system. The financial system, particularly here in Australia, but in other parts of the world, is relatively robust at present. And I think the evidence of that is the way the financial system has responded to a period where interest rates have increased at sort of very rapid levels. The shift in rates has been very high. That's caused some stress. And even where we've lost an institution or two along the way in the US or most significantly Credit Suisse, those things happened without causing major instability in the system. They were worrying things, obviously, for regulators and others who were involved, I'm sure. But actually, the totality of the system held up very well to those failures, which is not something I think would have happened before. So I think the core of the financial system is pretty strong. And what you end up thinking then is, well, sources of instability will come from other things that the financial system hasn't expected or hasn't seen coming or no one could anticipate. And so that will be things like geo-political events that have macroeconomic impacts, rapid shifts in policy that might come from new governments that are being elected around the world, something that comes out of left field that people didn't expect, a cyber event which takes out a significant institution, or a failure of a piece of critical financial infrastructure such that liquidity of payments and transactions can't happen as people are expecting them to happen. So, long answer to your question, which is to say it's probably, if I had to bet, next sort of bout of significant instability in the financial system far more likely to come from what you might call operational or resilience issues that come from the operation of the financial system rather than necessarily the traditional financial credit market risk. But I could be wrong.
Okay, thanks very much for that, Wayne. Elizabeth, would you like to add anything to that question?
Yeah, so I support a lot of what Wayne's just been saying. And of course, I think we have to congratulate Wayne and other regulators who actually did a pretty good job post-GFC of helping to make our financial system a lot more resilient than what it used to be. In preparing for this event, I actually went on to AI, as you do these days, to ask AI what it thought were the greatest risks posed to financial stability. The answer that it came up with was, it had four answers. It always seems to come up with four answers for some reason. Debt accumulation, commercial real estate, a disinflation surprise, and geopolitical fragmentation. So I would like to suggest it's probably none of them. So I then went on to ask AI, does AI pose a risk to global financial security? And it said, most certainly yes. And in fact, Gary Gensler at the FCC has raised some concerns about the use of AI, and that but I actually think that the problem I have with AI is it's not so much what Gary Gensler talks about. It worries me that too much AI is discouraging us from actually using our brains. That to me is the bigger problem. And sadly, I sometimes see it in our students, but hopefully our programs are encouraging them to think critically. I think, and it just comes back to these human biases. In a sense, we are the biggest risk to financial stability because of, our overconfidence and availability bias and so on. So we need to work hard at overcoming those problems that we have. I'm going to come right out there and name the elephant in the room, which is Donald Trump. So I think we can't have a discussion tonight without mentioning that guy. Sorry for getting political, but I do worry. And I think it's, there are, I guess combined with the concerns that I have and many people have about climate change, the world is warming way faster than we thought it would. We're already past 1.5 degrees. And I worry that a new Trump administration would slow down all the climate change efforts, to turn off that tap. It would be, and so climate change could actually get a lot worse over the next 10 years. And then you start thinking about, if you had multiple extreme events, fires, floods, hurricanes at about the same time. And, think about the impact on the insurance industry. Think about strain on governments, mass movement of people, and all of this happening in an environment of increased protectionism, nationalism, which Trump is promoting, and of course others not. There are others like him in other countries. So I think. Those are some of the things that concern me.
John.
So certainly I think, as Wayne said and as Elizabeth said, the biggest risk to financial stability is us, because greed and fear are the fundamental elements of almost every financial crisis, greed followed by fear. And until we change to be robots, that will always be a factor there. So certainly I agree that that's there. But as I was thinking about, what is the greatest risk, I could come up with any number of possibilities. And what I thought was, perhaps not a high possibility, but nonetheless something where if it happened, the consequences would be dire indeed, is something where basically your assumptions prove to be wrong. And also drawing on the fact that the seeds of the next crisis have been sown previously, have already been sown. This is kind of trite, but putting these together, what I came up with is something called the bank sovereign nexus, which is basically, as part of the response to the previous financial crisis, financial regulators very sensibly have said a whole lot, financial institutions need to hold higher quality assets, sovereign debt. So you now have a large concentration of sovereign debt on financial institution balance sheets. And the assumption everybody is making here is that sovereign debt is safe as houses, maybe. And so I think if that assumption, that sovereign debt was not nearly as safe as everybody had assumed, you've got a really big problem then. Because what we've now got is we've got large amounts of sovereign debt out there actually cleaning up after the previous financial crisis. You've got financial regulators that have insisted on holding more of that, which means that if the assumptions we make about how safe it is prove to be wrong, there will be problems all over the place. Now, Elizabeth mentioned could be one with US debt, but this is certainly not confined to the US. I think there are a lot of places where you've got questions about there could be shocks in the future that mean suddenly the banks and the sovereigns go down and there's nobody there to be a backstop. And then I'd be really worried.
So I take it you have no sovereign debt in your portfolio?
I have a super fund, which means I'm sure I do.
Thanks very much for that, John. The next question I think I'm going to pose first to Elizabeth. Elizabeth, what steps can be taken to ensure the stability of the financial sector, particularly in the face of potential global financial instability? And also, how can individual financial institutions improve their own stability, and how could regulatory oversight be strengthened?
Okay. I'll start by focusing more on individual institutions. I actually think Australian financial institutions have made a lot of progress. For example, I'm a big fan of the BEAR, the Banking Executive Accountability Regime. I'm a big fan of the reforms we've had in remuneration in Australia. And, these things are very important for getting the incentives right so that senior executives are more likely to manage risk appropriately. Okay, so those are positive steps. It does work. Going back to my concern about the United States, I think one of my concerns is that I don't think they are as far along in terms of good governance, accountability, risk culture. And so I think if I was so thinking about those US financial institutions, I mean, you could say, well, it's a regulatory problem. They should, the regulators in the US should do more about governance and so forth. But of course, you don't have to wait for regulation. So good directors should be making changes before the regulators require it. So those are the sorts of things I'd be looking at. So taking remuneration as an example, it's very unusual in the US for entitlements ever to get clawed back after a big scandal. Okay, really, the only way clawbacks ever seem to work over there is if there's been fraud or misconduct. Now, I don't think that's right. I think if senior managers have done a bad job of managing risk, even falling well short of fraud, that still should be a reason to claw back entitlements and thus creating genuine accountability. Okay? So those are the things that I think we're actually a long way ahead of the US. So I would be really encouraging the American companies, financial institutions, to be looking at that issue. I think but I'm sure you'd like me to say something about Australia as well. I think we could still do better in terms of our governance. With all due respect to Wayne sitting next to me, who is a non-executive director of a financial institution, I'd still do worry about the quality of Australian directors in general. Obviously, there are some excellent ones. But I don't think the standard is generally high enough. Another problem I have is that I don't think there's enough genuine diversity. People go nuts over gender ratios. I don't think that's the point of it. Although, I mean, of course, women should be, and different races should be well represented on boards. But that's not really what I'm talking about. What I'm talking about is having real diversity in terms of thinking. Trouble is, most boards are stuffed full of accountants and lawyers. And I don't think there's enough technology experts. And if you think about, some of the risks that Wayne mentioned earlier, things like cyber risk, thinking about AI, thinking about the blockchain, all of these really complex technologies, and I don't think there's enough directors that really understand them. So that would be my top tip for having good governance in financial institutions and thereby making us more resilient to the next shock. That's probably enough from me.
Well, thanks very much for that, Elizabeth. Wayne, do you have something to add to that answer?
Yeah, so I'll ask Elizabeth later which bucket I'm in, but...
Still unproven.
Yeah. So the way I think about it, if you're trying to sort of protect yourself against bad things happening, you can do one of two things. You either try and reduce the probability of the bad thing happening, or you reduce the sort of loss if the bad thing's happening. So a probability default, loss given default if you're a credit modeller. When it comes to reducing probabilities, I actually agree with what Elizabeth said. A lot of the post-crisis reforms have been implemented and the banking system is stronger, but there are significant parts of the world which still haven't delivered on reforms that were agreed to in 2008, 2009, 2010. In fact, if you go to the US at present, you can actually see television ads from lobby groups telling the regulators not to implement the reforms. It's very contested space. So first thing I would say is implement the agreed reforms that we learnt the lessons from the last crisis. That'd be a good place to start. But I sort of think if we could achieve that, we'd be better off not just ratcheting up requirements higher and higher and higher and having more capital and more liquidity, etc., because there's a point at which that becomes counterproductive. Better spending time then on what I call the loss given default part of how do you minimise the loss if the bad thing happens. And that really involves both for financial institutions and for regulators, thinking about those bad things, stress testing, scenario testing, thinking about the unusual scenarios, not just some macro scenario where GDP falls X and unemployment goes up Y, but something a bit unusual and unexpected. And then making sure you have a plan that would allow you to respond to those scenarios, know what you would do to recover in the event of an outage, or the payment system is down for a period of time, or whatever it might be. So plan and practice those plans. And then the last thing I'd say is there's a critical piece of crisis management tool, for want of a better term, that is designed to prevent instability, but I think increasingly is going to fail us, and that's deposit insurance arrangements. So historically, deposit insurance arrangements are different types around the world, but are there to protect depositors, calm depositors, and stop deposit runs. And they worked very well in a world where actually you went to your bank maybe once a week, took some money out, but you had money in your wallet and you had cheques you could write, and that you existed without digital money. But how many people in this room have enough money in their wallet right now they could survive a week if all their cards were cut off? One. Okay, there's a couple.
I hear fasting's really good for your health for short periods of time.
Yeah, okay. So most people couldn't function. The deposit insurance regimes in many places around the world are designed, yes, we'll protect your money, absolutely we'll get your money to you, but it's going to take a while. But that doesn't cut it in a world where you don't already have cash in your wallet and a checkbook that you can use to pay things. If you saw or if there was sort of nervousness in the community, concern about access to money, and then people learned, well, if there's a problem at my bank, I could be cut off for a week from all sources of money, they will take their money and run. Deposit insurance will not provide any sort of risk mitigation. So this is not an Australian problem, this is a global problem. But I think it's something that we're going to have to face up to, because many countries around the world rely on deposit insurance as a key sort of dampener of stress and nervousness. And I just think increasingly it's going to become far less powerful because we're all digital these days. Or most of us are digital, except for three guys over here.
Thanks for that, Wayne. John, do you have something to add?
So I guess I'd try and thinking about what Wayne said about loss given default, and really the old principle of diversification. So what you notice in a lot of cases is in previous financial crises, you got a lot of people who get really excited and go all in on whatever the next new thing is. And then they're usually the ones that are lauded the loudest on the way up and crash the hardest on the way down. So Silicon Valley Bank, for example, was a minor tremor, but they were basically all in on Silicon Valley startups. And I think one of the things that many regulators do, but clearly not all of them, is really to emphasise diversification, and diversification where you're trying to make sure you're holding, you are not exposed to one event in any part of your portfolio. And given my earlier answer, maybe that also includes sovereigns, or at least one sovereign. You shouldn't be all in on any one particular sovereign, and so holding some diversification there as a way of protecting against one geographical area of the world having some geopolitical events or anything else.
Okay, thanks, John. So the next question I'm actually going to put first to John. It's a little related to an answer you gave to an earlier question, but the last global financial crisis led to very large increases in public debt to GDP in many countries. Are we approaching limits to how much we can use government balance sheets to manage future financial crises?
So now you're going to think I'm going to be contradictory. So I will give you the short answer, I don't think so, but then I'll give the longer answer. And the short answer, expanded, is that debt levels we used to worry about, or we used to think that there was some kind of ratio of debt to GDP that you couldn't go past. I think there's research, some of which I did, which suggests that 90% debt to GDP is not some magical number. If you go over that, bad things happen. But deficits matter. And so this really goes to, can you say that the public sector has a sustainable profile or a sustainable way of getting back into balance? And I think that is something that is actually increasingly being questioned, as there are a lot of governments running primary deficits, which is they're basically spending more money than they're bringing in, quite apart from any of the interest costs. And so the key in terms of, you can spend a large lump of debt on really important stuff, like I think a financial crisis, and nobody is going to question that. But if your ongoing budgetary position is not sustainable, if you actually haven't got your house in order before that happens, that's just going to snowball. And so what I would say is the debt levels, I think you should be less concerned perhaps than you were in the past, but you should be more concerned about the ongoing deficits and whether the public sector is actually in a situation where they can eventually pay it back.
Okay, thanks, John. Wayne, do you have anything to add to John's answer?
Yeah, so I think, particularly here in Australia, I don't think we have a problem. We're still a AAA rated country. We might think sometimes, we might fret if you read purely domestic press about the state of government finances are appalling, but if you look anywhere else in the world, our balance sheet looks quite pristine, to be honest. I think it also depends on what you need to do. So and that largely, for a country like Australia, that is driven by, is the problem here in Australia? So do we have a hole in the balance sheet of our banking system? Or as in the GFC, was the problem elsewhere? And we were just a small boat in stormy seas that was trying to navigate through some pretty difficult times, but fundamentally we had a good banking system. In that case, the Australian government put a lot of support behind the banking system. Wholesale guarantees, it introduced the $1 million deposit insurance arrangements, but it didn't actually write many cheques for people. In fact, I don't think it wrote many cheques at all for the banking system. And in fact, it charged a fee for the wholesale guarantee. It made money out of that exercise. That's very different to the US, which was at the epicentre of the crisis and where the government actually had to put money into banks. Well, the UK had to put money into banks to recapitalise them. So government balance sheets, point being, government balance sheets can be used lots of different ways. If you're actually having to write cheques and create sort of worse and worse deficits, that can be a big problem, as John said. But if you're using it simply as the backstop, it need not actually be that costly at all.
Elizabeth, do you have anything to add to those two extensive answers?
No, I'm happy to leave that in the hands of my betters.
Okay, thanks, Elizabeth.
Or prettiers.
So we have a little bit of time for a fourth question, and actually a bit of, I think Wayne's answer led a bit into this, is that so countries did have different approaches of actually managing the last financial crisis. You mentioned how countries used their balance sheets in different ways to backstop the crises. So if a future major financial crisis were to unfold, do you see any approaches that are more likely to be more effective or less expensive ways of managing a crisis?
You're flicking that to me?
Yeah, flicking that to you first, Wayne.
Well, I think actually the most... So every jurisdiction, if you start to sort of scratch the surface, their financial system, the banking system, the financial system, they're all different. There's no uniform answer to this that you can just take from one jurisdiction, say it worked there and pick it up and put it here. That's the first thing. The most important thing, though, is to have a plan, to go back to the point I raised before. Whatever your jurisdiction looks like, know what your plan is. There are a lot of people, I think, who were panicked in the GFC simply because it became clear to everybody that there was no plan. They're making this up as they go along. And that exacerbated the situation. At a time when you needed the public authorities to be calling for calm, it became very clear to the general public that the public authorities are actually no idea and scrambling very hard. You know, the US Congress being the classic example of we have the TARP bill, no, we're just voting it down and we have no other plan. I mean, so not having a plan is sort of fundamentally, you bring whatever pain on yourself, you deserve it if you don't have a plan. I think there's some tried and truisms. Badgett's rule about lending freely to solvent banks at a penal rate, that whenever he proposed that rule in whatever, 17 something or other, 18 something or other, still holds true today. That's a truism that still holds true. And then third, if you do a compare and contrast between the US and Europe, in the global financial crisis, what was the defining difference? The US forced recapitalisation of those banks. The Europeans didn't. The recovery in the US was a couple of years, and the recovery in Europe was a decade of pain. And that's not just pain for bank shareholders, that's pain for society, because they didn't get their banks functioning again, they didn't get credit flowing. So effectively, they bailed out bank shareholders by not forcing them to take their loss, and that was very painful. So forcing the recapitalisation on the US banks was absolutely critical to a successful recovery.
Okay, great. So we're getting short on time, but if John or Elizabeth want to add anything to Wayne's answer there, feel more than free to add.
I suppose I can express Wayne's answer in a slightly different way, which is there's kind of a crisis phase when you do whatever it takes, but that actually passes remarkably quickly. And it's after that you then need to move into the clean-up phase. And it'll cost a lot more if you don't deal with it quickly. I think that's essentially the point. So it's really about the crisis phase. I think, you really shouldn't be putting limits on it because that can undermine confidence. But once that passes, and it passes quickly, it's that clean-up phase where historically, if you drag your feet, if you hope things will get better, they generally don't and they drag on. And so the way you can minimise the cost, I think, from the experience is actually moving through that as quickly as possible.
I'll just say something brief. My reflection on the last crisis is that there was actually a lot of coordination between the different countries. A lot of coordination, and my concern is that in the new world that we're in now, coordination might be more difficult because there's so much more nationalism about. So in a more nationalist world, how do we coordinate? I guess it's just, I see it as potentially being a lot harder next time around.
Okay, thanks, Elizabeth. And now we're moving to the audience questions. And actually, the first question I think I'm going to throw to Elizabeth, since you brought up the Trump, because the Trump thing has captured the audience's imagination. So the question is, what would be the consequence of a second Trump administration's plan to implement Project 2025's recommendation to abolish the Federal Reserve System and adopt a commodity standard? Elizabeth.
Look, I can't say I'm all over that particular proposal, but in general, the point of weakening institutions that have been around for a long time is quite worrying. Yeah. By the way, I don't know how many people here read The Economist magazines. It's one of my must-read. And they, according to The Economist, towards the end of last year, they did say that Trump is the biggest risk to financial stability.
Okay. Wayne or John, do you want to add anything?
So I won't specifically comment on Trump or whatever, but I will make the observation that the current institutional arrangements we have are the worst ones, except for all the others that have been tried. And so commodity standards have been tried, and the experience under the gold standard was actually a lot of economic volatility. One of the great things that we perhaps have forgotten is how, despite the large punctuations, how smooth and benign, relatively speaking, certainly in Australia, our economic conditions have been. And I think that's the aspect where a central bank is a great innovation. Inflation targeting has been a great contributor to general economic stability. And the problem you have with commodity standards is that you have a lot more economic volatility, and ultimately this is bad for growth and bad for people's well-being.
Okay, thanks. Thanks for that, John and Elizabeth. The next two questions are tied, so it means I'll get to choose the order. So this one I'm going to throw to Wayne. Given the increasing role of private credit markets in global finance, what are the primary regulatory risks that we should be aware of?
Well, quite simply, the biggest risk is the inability to see really what's happening in portfolios. And regulators do fret a lot about that, to both domestic regulators, but in my previous life I spent a lot of time at international forums, and people were always fretting about what we used to call the shadow banking system, and then you weren't allowed to call it the shadow banking system, so it's non-bank financial institutions. And it's just the fact that it's occurring in the shadows, and it's much harder to see the warning signs of an exuberance or a chase for yield or whatever it might be that's occurring. You can kind of pick it up because you'll see credit or market activity shifting from the regulated sector into the less regulated sector, because I don't want to say unregulated sector because it's not always completely unregulated. But it's then that the unknown. And as if the unknown is small, which it still is in this country, it's something that you can tolerate. It's not a particularly cause for alarm, because if something was to go wrong, it's manageable, it's containable, it's not likely to create huge waves back over the regulated system. But in a market where perhaps the regulated system is less than half of the broader financial system, and that's certainly the case in somewhere like the US, then the lack of visibility and the lack of understanding about credit standards, about credit quality, is much more worrying. So it's that lack of visibility that's fundamentally the problem.
Okay, thanks, Wayne. Elizabeth or John, do you have anything to add?
Well, I guess also the lack of liquidity is the other point that I would just add on. So I guess it's all, and when liquidity starts to become a problem is when you combine that with high leverage. So if you've got companies that are highly geared and something goes wrong and the only assets that they've got to sell are illiquid, then you're really screwed. So I guess if there are a lot of hedge funds around that are like that, that could be a potential concern.
I think they've nailed it.
Perfect. So do I. So the next question, given John's mention of things that the latest fad that's way out there, the question from the audience is, do you think crypto will in any way affect or be affected by the next financial crisis? John.
I mean, its design, its reason for existence is to be independent of sovereigns and financial systems. But I could imagine one because it takes an awful lot of electricity to run the crypto system. And so this is quite apart from imagining any kind of flaw in their algorithms, which, while it hasn't been discovered in, let's say, Bitcoin, a few of the others, there are certainly knowledge that there are ways that the trust underlying them can be undermined. So I would say not directly in their design, but basically they're making assumptions about something that may not turn out to be true, and crypto is suffering from that just as much as any other financial institution, and the huge draw on electricity to just keep that market functioning, I think could well be a source of vulnerability.
Okay. Elizabeth or Wayne?
No, I mean, again, it depends what I think it depends what the sort of origins of the next financial crisis are as to whether it's positive or negative. Or if there's a technology-related problem, if people sort of become more worried about digital things, then maybe that's not good for something that is fundamentally a digital asset. On the other hand, if it's John's concern about sovereign risk that comes to the fore, people may well say, absolutely, I've got to get away from things that the sovereign is controlling. So it's really hard one to answer. It could be positive, could be negative, just depends on the circumstances, and there'll probably be a group of people who think, whatever happens, there'll be a case for more crypto, and another group of people who will continue to be skeptics.
Elizabeth? So the next one is firmly an economics question, I think, but with financial market implications. So I'll throw it to John again. So what are your thoughts on Australia's commercial dependence on China at the current fragile geopolitical environment and a potential conflict to be started between the biggest economic powers?
So I think we have a little bit of experience with the past few years where there were various trade strikes against Australia. And what that experience was that there was definitely disruption in the short term, but by and large, there were alternative markets. And I think this is what we're seeing actually happening around the world, is that certainly with commodities, the point about them is they're on ships and you can send them to many different destinations. And so I think certainly people are a little bit more cautious now about having all their eggs in one basket, but nonetheless, my expectation is when you've got basically a large world market for what you're selling, if somebody won't buy from you, well, they've still got to buy from somebody else, and whoever that person was selling to in the past will now be a buyer for your goods. And that's what we discovered in the case of the kind of the minor tensions recently, which was, there was some problems short term and there's a cost to that. But by and large, things worked themselves out and different markets were found.
Okay. Wayne or Elizabeth?
Can you just repeat the question, John?
I will. What are your thoughts on Australia's commercial dependence on China at the current fragile geopolitical environment and a potential conflict to be started between the biggest economic powers?
Well, look, I mean, obviously there's some risk there. That's one to be monitored. I actually don't see a huge risk of, a hot war. To me, it's more. Yes, there's the trade war angle, but it's partly all about managing it diplomatically, and I think the current government's doing a reasonable job of building ties again.
Okay.
I think there's sort of two challenges. There's the challenge which is perhaps John's point about what happens to trade and other things in the real world. And as you say, commodities, they're sort of fungible, they can move around, and you see that when the US put tariffs on China, what happened? Well, direct trade went down, but a lot of Chinese trade went into Southeast Asia, and a lot of Southeast Asian trade went to the US. So people find their way around those sorts of things. The challenge for Australia would be that the rest of the world sees us as China dependent. And so there is always the risk that there's a sort of perception issue or a reputational issue, that whether those, it proves to be not as bad as perhaps people may fear, that investors, lenders, international financiers of Australia say, well, we'll sort of run first and ask questions later. And that was sort of what happened in 2008, where anyone that had a mortgage on their balance sheet must be dodgy, because that's what they were in the US. And it took a while for people to understand actually that Australian mortgages are very different to US mortgages. And so, markets recover. But if there's a period of time in which Australia gets cut off from international investment, or the credit rating is downgraded, that's not good. Let's face it, that's going to be costly. Hopefully there's ways that we can come back from that.
Okay, thanks. So the next question, I think, is either for Elizabeth or Wayne. I might throw it Elizabeth's way first. Have the regulators done enough about enforcement of BEAR regime for it to be truly recognised as a valuable addition to risk governance?
Yeah. So no, I think that is a good question. I mean, we have to remember the way the BEAR is designed, it's primarily for the directors to impose accountability on the executive. So the only time that the regulators need to be involved is if the directors have dropped the ball. Okay, and I do worry a bit that I think we have seen examples where the directors are not quite on their toes sufficiently, and I am worried. I think if I could, wave my magic wand, I would love to see ASIC performing much better than what it does. I don't think ASIC is as good a regulator as what we really need in imposing accountability on the directors, and that's one of the reasons why I mentioned earlier my concerns about the quality of Australian directors. I don't think there is enough consequences, and that's essentially an ASIC problem in my view. How is it possible that we look at some of the examples like Crown Casinos and the way some of those directors performed, and yet none of them have had serious consequences?
Wayne?
Yeah, I'm wary of marking my own homework here. So I'll make a couple of comments though. First of all, I used to get a lot of complaints when I was running APRA that we haven't fined enough people. And as Elizabeth said, actually the BEAR regime doesn't include any fining power on individuals. That's not part of the regime. So regulators haven't fined people because there's no power to fine people, and that's not necessarily well understood. Regulators have one power over individuals in the BEAR regime, which is to disqualify them from the industry for good. You've really got to have done something terrible to do that, and the history has been whenever regulators have tried to do that, quite often there's been appeals, and appeals have been successful. You've got to really disgrace yourself to be disqualified for good. But BEAR shouldn't be entirely thought about as just the enforcement angle, because when we were introducing the BEAR here, we spoke to the colleagues in the UK who had the senior manager regime, which is their equivalent of the BEAR, and we said, similar question, you don't seem to have done much enforcement, has it had any impact at all? And they said, well, actually it has had a lot of impact, but it's on the prevention of problems, and they're hard to see. But if you get governance right, if you get accountability right within organisations, and you have organisations imposing their own accountability and consequences on people, maybe not well enough in all cases, but granted, but that's actually the strongest benefit from a regime like the BEAR regime. It's just very hard for most people to see that it's working, because a lot of that stuff is just happening behind the closed doors, so to speak, and there's no community demonstration, unfortunately, that you can have, other than very limited cases, to show that actually something has changed.
Thanks, Wayne. John, this might not be your sort of area.
Perhaps I'll do a corollary, which is I do think institutional culture is a really important part of how effective an organisation is. And as have both the answers have suggested, broadly prevention is much better than cure. And what you're really about, and it's very hard, is can you get some confidence that the internal culture is one that leads to the right questions being asked? And I think that's a very difficult one, because that goes to human psychology. But nonetheless, I do believe that the culture of an institution is a critical element in its success. And that is something that, with the directors, comes from the top. And maybe we're getting better at measuring it, but it's still very hard.
Funny you should mention that. I developed the Macquarie Risk Culture Scale for that very purpose, which is available free of charge on the website.
I think we'll charge for it now. Okay, thanks everyone for that, for those answers. Next question, I think I'll throw to John. It's a fairly general question. Do you think it'll be easier to bounce back from the next financial crisis?
Easier than the last one?
Yeah, the last one, I assume. Maybe given what we've learned in previous crises.
So I think my best bet is actually that it'll be a while until we get to the next one. So what I have tended to notice is it takes a while for people to forget. And so this perhaps goes to culture, or how nervous you are about things going wrong. So at the moment, people have crisis, and COVID is a big shock that is also causing people to just reevaluate their approach to risk and the way they think about things. So broadly speaking, I think the world is going to be much more cautious for an extended period of time. And that means that we're unlikely to have a crisis in the near future because of that inherent risk aversion at the moment. But by the time we get back to the next crisis, everything like that will have been forgotten, and we'll have moved on, and we'll be saying this time is different. So when it happens, I think it'll be just like it happened in the past, as we've learned. It's just a question of how long it takes to get there.
Wayne or Elizabeth?
Yeah, so the way I'd answer the question is if we had the same circumstances, because it always depends on what is the nature of the crisis, so every crisis is different. But if you could repeat 2000, or if 2008 repeated, I'm quite sure we'd do better this time around. The world would do better, but Australia would do better. The financial system is better capitalised, it's got more liquidity, it's more operationally resilient, regulators have got better tools, people haven't forgotten the lessons. So I'm quite sure that the mistakes that were made in 2008 wouldn't be repeated, and therefore we could do a better job of that scenario. The trouble is it won't be that scenario. And if it's a scenario which is a sort of a new type of risk, cyber being the obvious example, we haven't got the practice. We haven't had the real world scenarios where a major financial institution has some kind of cyber attack that takes it out, or the payment system is taken out of operation for a period of time. Those sort of things just haven't had the experience with. So inevitably there's playbooks and plans for that, but they haven't been tested in any kind of real world experience. So those sort of things will still be inevitably making new things up as we go along.
Elizabeth?
Yeah, just to repeat my earlier point that I do have a concern that the coordination task will be much harder next time around because of increased nationalism and perhaps the decline of some of the institutions that have served us so well in the past. So, yeah, that would be my biggest concern.
Okay, thanks. And I think we have time for one more, maybe a second question. But this question's quite different, and I'll let whoever wants to answer it first. Is what role, in your view, does the media play in moving the economic situation talking doom and gloom all the time often affects people's behaviour. So maybe since it's an economics question, maybe I'll throw it to John first.
So I have wondered about this myself, and certainly there's been a lot of emphasis on confidence indicators, and even did some research on it to try and work out, do confidence indicators actually have some effect on real things, or are they merely reflecting what is actually true in the economy? And I think this really goes to the media in the way it can, can it create something out of whole cloth, or is it merely just reflecting what everybody is talking about or experiencing? And my general feeling is that the media reports on what is there. They may amplify some things, but it's very hard for them to create something that's independent of that. And so I think the media is a very valuable resource for shining light onto what's going on. But the fact that things seem to perhaps snowball after it comes to light in the media is not a sign of kind of the media causing something. It's merely a case of that was already there, and what we are now doing is getting to the cleanup and dealing with the problem rather than it being hidden. So really, I think, no, I don't think the media creates it, and I think the media is good in that respect, even though sometimes people want to shoot the messenger.
Wayne or Elizabeth, or both?
I think the high-quality media, having high-quality journalism is really important for, just for making sure that issues are debated and brought to light. I agree. I think sometimes the media does excessively focus on things. The example of the cost of living, crisis, as it's called, and sure, yes, that is a thing. There is a section of society that is really struggling, but I actually don't think it's quite as widespread as what you would believe just by reading the popular press. It's an example of what you're talking about.
And Wayne, any final words? Nope, that's the final word. So Elizabeth, thank you very much for those final words. And actually, we have come to the end of our session. So thank you very much to the panellists, to John, Elizabeth, and Wayne. Thank you very much to the audience for your questions. And if we could all just thank the panellists.